In the cryptocurrency market, Bitcoin is pricey. Not everyone can afford Bitcoin, and people can reap the rewards, making the critics envious. But there is a way where everyone can invest in Bitcoin cheaply. If you want to know more about this, then I suggest you keep on watching. This video is brought to you by Answerly, a question platform that pays you for adding high-quality answers on different questions. The users are rewarded in Answerly tokens, which they can easily convert into dollars or any other cryptocurrency by using one of the exchanges mentioned in the description. Hello and welcome to our YouTube channel. In today's video, we'll be talking about the #1 advice for new cryptocurrency investors in December 2021. Known as the dollar cost averaging, it's an investing strategy that can lower the amount of Bitcoin and minimize risk. The logic is simple. Instead of investing huge amounts of money in one go, dollar cost averaging refers to buying small amounts at regular intervals despite the price. Over time, this method will result in increased returns. To stay in the game or dollar cost averaging, this strategy manages the price risk when you're buying large assets like Bitcoin. Instead of purchasing an asset with a single purchase at one price, dollar cost averaging divides the amount that needs to be invested to buy small quantities at regular intervals. This decreases the risk before the price drops. Dollar cost average only works for long-term investments where asset prices tend to rise. In short-term, asset prices do not change constantly. Instead, the short-term highs and lows that the market experiences do not follow any predictable pattern. When the price is low, many investors have tried to time the market and buy assets. But according to professional stock pickers, it's easier said than done. Dollar cost averaging makes investing more practical and less emotional. It makes an investor buy fewer assets when the prices are high and more when the prices are low. Speaking about practicality, this method will help those crypto investors who only have small amounts to invest. Often, such investors don't turn towards Bitcoin as the price is always higher than every other cryptocurrency in the market. Even when the price dips, other cryptocurrencies like ethereum, Litecoin, and Bitcoin Cash will have their prices lower as compared to the leader of the cryptocurrencies. Dollar cost averaging gets a smaller amount of your money in the market regularly. This way, an investor doesn't have to save up huge amounts of money and wait for the time to come. In dynamic markets like cryptocurrency, where price volatility is a major drawback, waiting for the right time might take away so many opportunities to make profits. Rather than crying over spilled milk, dollar cost averaging is an expert's way to evade mistiming. You are probably wondering, how does it work? With dollar cost averaging, you first decide on the total amount you wish to invest, along with your chosen investment products like stocks, crypto, commodities, etc. And then, instead of investing the money as a lump sum, you invest it in smaller equal installments over a specific length of time. You may place your TCA trades manually, but there are vehicles such as 401k plans and some dividend reinvestment plans that can do it for you too. Once set up, your purchases occur automatically, regardless of asset price or movement in the market. Committing to dollar cost averaging means that, at times, you'll be investing when the market or a particular asset is dropped in value. It also means there will likely be times when you're buying during a market sell-off in which a huge volume of assets sells in a very short period. Some investors might be reluctant to purchase securities during bear markets experiencing price declines. But viewed from another perspective, buying when the market is down gives you the opportunity to land potentially profitable assets, perhaps different from the ones in your TCA plan at very low prices. By buying when others might sell, dollar cost averaging can potentially help you to reap the benefits of buying low and selling high. Before we go on and continue the topic, smash the subscribe button and click the notification bell right now, or you'll get confused at knowing when to take part in dollar cost averaging. Some drawbacks of dollar cost averaging frequency. Because many trading platforms charge a fee each time you make a transaction, you're going to incur more trading costs with a dollar cost averaging strategy. The good news is that TCA is inherently a long-term strategy, so ideally, fees should potentially become small relative to your potential gains over 2, 5, or 10 years and beyond. The most notable downside of DCA is the possibility that you might miss out on a large gain you could have earned if you had invested in a lump sum when the market was down. But any big windfall profits requires timing the market correctly, and even professional investors can't necessarily predict intraday or even weekly movements of a stock or the market as a whole. DCA is potentially a safer way to take advantage of big market dips. Another downside is that you may buy after a steep rise in asset prices and face a downward correction afterwards. A DCA strategy over time usually includes buying assets at any stage, whether it be stable, depreciating, or appreciating. If done consistently, a DCA strategy tends to lower your risk and does better over a long time horizon. So, when is DCA more effective than lump sum investing? DCA can help an investor safely enter a market, start benefiting from long-term price appreciation and average out the risk of downward price movements in the short term. And in situations like the ones below, it may offer more predictable returns than investing a lot of cash at once. Buying an asset that may increase in value over time. If an investor thinks prices are about to go down but are likely to recover in the long term, they can use DCA to invest cash over the period of time they think a downward movement will happen. If they're right, they'll benefit from picking up assets at a lower price. But even if they're wrong, they'll have investments in the market as the price increases. Hedging bets through volatility. DCA exposes investors to prices across time. When a market experiences price volatility, the goal of this strategy is to average out any dramatic increases or decreases in their portfolio and to benefit a little bit from price movement in every direction. Avoiding FOMO and emotional trading. DCA is a rule-based approach to investing. Often, beginner traders fall into the trap of emotional trading, where buying and selling decisions are dictated by psychological factors like fear or excitement. These can lead investors to manage their portfolios ineffectively. Think panic selling during a downturn or overbetting due to fear of missing out on exponential growth. Example of dollar cost averaging. First scenario, let's say you want to spread out $300 and invest $100 over 3 months. If you want to invest in a security that's trading at $20 per share, you'd be able to purchase 5 shares in 1 month or $100. The next month, when you have another $100 to invest, the price soars to $50 per share and you'd be able to purchase only 2 shares. After a market drop the third month, the price is down to $10 per share and you'd be able to buy 10 shares. In a 3-month period, you'd invest $300 and have 17 shares. In this example, even with price fluctuations over the 3 months and $300 invested with 17 shares, your average cost per share is $17.6. If you were to sell in month 4 at $20 share price, the same price as month 1, you'd sell your 17 shares for $340 with a profit of $40. If you were to sell in month 4 at a $40 share price, you'd sell your 17 shares for $680, making a profit of $380. A second scenario, if you choose to go with the lump sum investing strategy and chose to invest $300 in that first month at $20 per share, you'd have 15 shares. That's 2 fewer shares you'd have compared to consistently putting money into the market. In this example, dollar cost averaging would beat a one-time lump sum investment. On top of that, your average cost per share is a few dollars lower as well, $17.6 versus $20. In this case, if you were to sell in the month 4 at $20 per share price, you'd sell your 15 shares for $300, effectively breaking even and not making a profit. If you were to sell in month 4 at a $40 share price, you'd sell your 15 shares for $600, making a profit of $300. While dollar cost averaging won out in this hypothetical scenario, that won't always be the case. Yes, dollar cost averaging is a good strategy in spreading your risk and lowering the average amount you pay for shares. But there's a strong case for lump sum investing, which exposes you sooner in the market and has been found to be more beneficial as a strategy. Well, there you have it, one of the most important advice that you can take if you're just entering the world of investors. How important do you think dollar cost averaging is? Let's know your thoughts down in the comment section below. If you like this video, make sure to smash the like button and subscribe to this channel. To learn more about Answerly and Answerly tokens, check out the links in the description.